This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the explosive growth of artificial intelligence, specifically whether the current surge in mega-cap tech stocks signals a sustainable structural boom or if the market is heading into an AI bubble reminiscent of the dot-com era.
It really is the biggest question in markets right now.
We'll also look at the massive underlying hardware build-out and key forward-looking opportunities in the semiconductor and robotics spaces.
Absolutely. We have to separate the hype from the reality.
Links and resources are in the description below. If you find this podcast helpful, please consider subscribing to the channel for more market updates.
So yeah, I mean, the velocity of change has just been staggering. We saw NVIDIA become the world's first $4 trillion company.
And then it just blew past $5 trillion in 2025.
Exactly. And when you realize that AI-related companies accounted for, something like 80% of the entire American stock market's gains that year?
80%. That number alone.
Yeah.
It should give anyone pause.
It really should. And that's the core conflict we have to dig into. We're looking at, unprecedented valuation concentration on one side.
A lot of speculative behavior.
A lot of it. But on the other side, there's this narrative that this time, the boon is actually anchored by really strong underlying earnings and genuine structural demand.
Okay, so let's unpack that. I think we have to start with the voices warning about a bubble. I mean, it's not just fringe figures, is it? We're talking about Sam Altman, Ray Dalio, the Bank of England.
The IMF. They're all drawing these comparisons back to the year 2000.
So beyond just the dizzying stock prices, what are the specific warning signs that are, flashing red for them right now?
Well, the first, and I think maybe the most powerful sign, is just the sheer market concentration.
Right.
We are seeing the S&P 500's concentration reach its greatest level in, half a century?
50 years. The 5 largest companies holding up about 30% of the entire index.
30%, yeah. I mean, if that handful of companies even sneezes, the whole market is going to catch a serious cold.
And when we look at the traditional valuation metrics, they're undeniably stretched. We've seen the S&P 500 trading at 23 times forward earnings. That's high.
It is high.
But there's another metric that was flagged, the Case-Shiller price-to-earnings ratio. It's exceeded 40. For anyone listening, maybe you could explain what that is and why we should care that it's hit that level.
That's a really crucial piece of context. So the Case-Shiller PE, or you'll hear it called the KPE ratio, it uses the average of the last 10 years of inflation-adjusted earnings.
So it smooths out the short-term noise.
Exactly. It makes it a much smoother, more reliable gauge than your standard PE. And historically, seeing it get above 40, that means we are in territory only seen during the absolute peak of the dot-com bubble.
And the 1929 crash.
So it signals truly historic levels of overvaluation relative to long-term profitability.
So the valuations are high, but the speculative behavior is also ramping up. You mentioned that leverage buying has really shot up.
It has. We saw U.S. margin debt. So that's money borrowed to invest in stocks. It increased over 32% between April and September.
Wow.
And that kind of really steep surge has only happened before around the market peaks of 2000 and 2020. It tells you that a lot of the capital driving this rally is leveraged.
Which makes the market really vulnerable to a sudden correction.
Or highly susceptible, yeah. But the risk goes even deeper than that. Let's talk about this really unique structure, this idea of circular financing.
Or vendor financing, right, where the biggest players are essentially funding the ecosystem that then buys their products.
This is the most complex and I would argue the most concerning part of this whole boom. You take NVIDIA's huge investment into OpenAI.
Okay.
It strengthens their partnership, sure, but it raises a lot of questions. It's based on this expectation that OpenAI will use that money.
To buy more chips from NVIDIA. Yeah.
It becomes this sort of closed-loop system where the main supplier is basically funding its own demand.
Yeah. That sounds suspiciously close to creating a perpetual motion machine for demand.
Yeah.
There was another example with CoreWeave, right? The AI cloud provider.
Yes. So NVIDIA owns a 7% stake in CoreWeave, but at the same time, it signed a $6.3 billion deal to purchase CoreWeave's unsold data center capacity.
So wait, the supplier is buying back the customer's unused product to guarantee utilization? I mean, how can we possibly trust the revenue or the valuation data that comes out of that?
Well, it creates a major challenge for analysts. Absolutely.
Correct.
The worry is that this kind of financial engineering, it masks the genuine organic end-user demand.
And profitability.
It helps sustain these sky-high valuations. But if those funding mechanisms ever, seize up, the perceived demand just evaporates instantly.
That is a powerful risk. Okay, but let's pivot to the bull case, because the contrast with the year 2000 it's pretty stark. Back then, so many companies were just concepts with zero revenue.
And that's the whole defense against the bubble argument, right? Today, these valuations are anchored by really robust earnings growth and powerful cash flow.
These are real businesses making real money.
Huge money. These firms are delivering incredibly high margins. We're seeing gross margins expanding to 55, even 65% in a lot of these infrastructure segments.
So the multiples might be high, but there's actual growth to back it up.
To a degree, yes.
Yeah.
I mean, you look at the sector, the forward price to earnings ratio is about 25x. High, yes, but that is literally half the multiple we saw during the dot-com peak. The growth is justifying the valuation, at least for now.
And the balance sheet strength is critical here. This isn't financed with reckless borrowing. The Magnificent Seven have massive cash reserves.
Right. This is largely financed by free cash flow. They have very low leverage compared to those super indebted companies that collapsed in past cycles.
But, and there's always a but, the strong fundamentals of the suppliers don't just erase the risks for the customers, do they?
No, they don't. And you can't ignore that this massive technological investment might be outpacing actual commercial success. This brings us right back to the immediate volatility drivers.
We saw a perfect example of that market sensitivity, didn't we? Early 2025 with the DeepSeek chatbot.
And we did. It was a successful launch of a Chinese-made competitor, a state-of-the-art model.
And NVIDIA's stock dropped 17% in one day.
70%.
Yeah.
Now, it recovered, but that massive swing shows you just how much uncertainty is priced in around competitive threats. It shows how easily that valuation concentration can unravel.
And this gets to the structural risk that I think should really concern people, which is the monetization challenge. There's an MIT report that found a really startling figure.
Up to 95% of enterprise AI projects have not yet delivered measurable financial returns.
95%. Let that sink in.
And to make it worse, only about 3 to 5% of AI application users are currently paying subscribers.
So companies are spending billions and billions of dollars to implement AI.
But it's not yet translating into a clear, measurable ROI for the vast majority of them.
It's a massive tension, isn't it? The software and service layers are struggling to pay their way, but that spending is still creating a tidal wave of demand for the physical hardware.
And that failure to monetize is creating the perfect setup for this infrastructure arms race problem.
An arms race that's fueling projections for data center capex to exceed, what, $1.2 trillion globally by 2029?
And some estimates go even higher, maybe 3 to 4 trillion by 2030.
Wow.
And this is where history can, repeat itself.
Yeah.
If that demand growth stalls, or if that 95% failure rate just keeps going, this massive infrastructure build-out risks the historical pattern of overcapacity.
It's the railway mania problem all over again.
Exactly. We built all the tracks because we thought everyone would take the train immediately. But if the application demand isn't there, we've just built a very, very expensive, empty superhighway for data.
Okay, so the lesson here is that even if the software side is volatile, the demand for the physical hardware seems structural. It seems locked in for the long term. Let's shift to the bedrock of this whole boom, semiconductors.
Right. Global fab spending alone is projected to be over $1.5 trillion between now and 2030.
And that demand is moving way beyond just data centers. It's being driven hugely by the auto sector, right? Electrification and autonomous driving.
A huge driver. For EVs, the rapid switching of high voltage power, it demands these specialized components.
We hear terms like SiC and GaN thrown around a lot. What exactly are silicon carbide and gallium nitride, and why are they suddenly so essential?
So they're next-generation power semiconductors. They offer much faster switching speeds and drastically reduce power loss compared to old-school silicon chips.
Which is critical for an EV.
Absolutely crucial. Every bit of power you save translates directly into better range, better battery life, and faster charging. They are the materials that make high-performance power control possible.
And then, as we move toward level 3 autonomy and above, the chip count per car just explodes. A conventional car has a couple hundred chips.
An autonomous vehicle could require over 1,000.
1,000 chips per car.
Yeah, and that needs high-performance computing system on chips and dedicated AI accelerators just for all that real-time data processing. Plus, the industry is shifting to what's called a zonal architecture.
So instead of dozens of little computers all over the car,
you have one central computer that manages everything. And that fundamentally changes the demand for high-speed memory and specialized processors.
So beyond cars, where else is this persistent long-term chip demand coming from?
We see it clearly in the energy transition. The renewable energy market is projecting huge growth, a 17.3% compound annual growth rate through 2030.
And that needs those same 6C power chips.
For stabilizing the grid, for managing variable sources like wind and solar, yes. We also see defense budgets rising everywhere, driving demand for durable GaN-RF chips and specialized AI processors for automated systems.
So the structural demand is undeniable, but the supply chain is, well, it's deeply tangled in geopolitics.
It is. We're seeing a major strategic shift toward regional resilience. It's about security now, not just pure cost efficiency.
And Taiwan and Korea are still the absolute leaders in the most advanced chips, the sub-7 nanometer ones.
They are, and those rely on EUV lithography equipment, which is this critical choke point. It's supplied almost entirely by one company, ASML.
Meanwhile, China is pushing hard for domestic self-sufficiency. You pointed to a development with Cambricon Technologies.
Yeah, Cambricon. They're often called China's answer to NVIDIA. They struggled for years, but recently reported their first ever quarterly profit. And this came after intense government pressure to replace foreign processors with local ones in major state-backed AI projects.
So we need to be prepared for regional champions and dual supply chains.
Exactly. Not one global optimized system anymore.
Okay, shifting to the horizon, let's look at the next wave of physical adoption that will need all these advanced components. Humanoid robotics.
The robotics forecast I find it fascinating. Analysts estimate the global humanoid robot population could jump from just 18,000 prototypes today to 1 million by 2030.
1 million by 2030, and then 10 million by 2035.
10 million by 2035, according to a Bank of America analysis.
Yeah, that is a massive scale up in a very short time. So where does the investment focus shift in that next wave?
It shifts to securing the supply chain for the really complex advanced components. The AI processors, the sophisticated sensors like LiDAR, and crucially power management ICs or PMICs.
Why are those so important?
They're vital for ensuring efficient, cool, and reliable operation in a mobile platform. And the market is also moving toward robots as a service, RAAS models, which will lower the barrier to entry for everyone.
There's one final macro factor we should touch on, U.S. trade policy.
Yes, this raises a really important question about global economic friction. An analysis from Oxford Economics found that just reversing the recent U.S. tariffs could provide a pretty significant boost.
How significant?
It could add 0.5 percentage point to global GDP growth annually and reduce U.S. inflation by 0.4 percentage points through 2029.
So it's a major policy lever to watch.
A major one, yes. While there's no clear sign of a reversal, the potential impact is just too big to ignore.
And looking even further out, quantum computing, does that just derail this whole silicon boom?
Not at all. Not in the foreseeable future anyway. The current landscape is all about hybrid quantum computing. So the quantum processors handle specific complex calculations at massive speeds.
But they still need conventional silicon.
They still need conventional silicon GPUs and CPUs for essential tasks like controlling the quantum environment and, most importantly, for error correction. It's a synergistic demand. It will likely expand the market for high-performance silicon, not displace it.
Okay, that was a truly deep dive. So what are the most critical takeaways you think people should walk away with today?
All right, let's try to consolidate the key points.
First, the AI rally is structurally different from the dot-com era. It's supported by robust earnings and healthy balance sheets, but that risk of extreme market concentration, the highest in half a century, that remains acute.
Second, you have to pay close attention to the unique risks of circular investments that can obscure true demand. And the major challenge that 95% of enterprise AI projects are still failing to deliver measurable returns, that gap creates huge potential for volatility.
Third, the structural hardware demand seems locked in for the long haul. It's driven by trillions in projected data center capex, the transformation of the auto sector with new chips like SATA and GaN, and the explosion of the humanoid robotics market.
And finally, geopolitics. The pressure is actively changing the supply landscape. It's accelerating localization and fueling the rise of domestic alternatives like Cambricon in China. And that just introduces a whole new layer of complexity and risk.
So the AI cycle it's less a classic bubble based on zero revenue, and it's more a structural boom with some acute concentration risk and a huge monetization challenge. The key question for you as an investor is no longer if AI is real, but how to navigate the inevitable sharp volatility. The volatility caused by the gap between genuine technological progress and the market's speculative overenthusiasm.
And maybe here's a final thought. Given that high-level autonomous vehicles are still a decade or more away, and enterprise AI projects are failing 95% of the time, what does the sustained multi-trillion-dollar infrastructure build-out over the next 5 years imply about adoption outside the auto sector? Which non-tech industries are poised to benefit most from leveraging that massive, newly built data superhighway first?
Thanks for listening to the 15-Minute Investor.